So I was preparing for a finance workshop that we are conducting today, and I thought let's make some content around it. So it is going to be a very raw content, not highly edited or anything, not highly planned. I don't even have a script. I'm just going to be preparing whatever I'm preparing and also kind of creating content around it. So the part I'm going to take is about quantitative analysis of companies in the stock market. So how do we do quantitative analysis? What all factors do we look for? Like profit and loss, balance sheet, shareholding pattern, all of that stuff. Right. So these are going to be the points I'll be covering and explaining. Obviously, this is going to be a very raw video, so it's going to be free flow. And I think a free flow video might just work better because I just want to be authentic with you guys. This is kind of also like a day in my life, a unique day in my life, you could say. So yeah, let's get to it. Currently, I am researching about CDSL. CDSL is Central Depository Services Limited. It's a very well-known stock and also very well-known company because what it basically does is that it helps store your financial instruments in dematerialized form, which is a digital format, right? So we can understand it as via banks, right? Banks store cash or your money in the physical form, right? And also you can store your gold and stuff like that. But on the other hand, CDSL stores your financial instruments, your financial securities in the digital form. But now, what are financial securities? Financial securities are things like stocks, bonds, your anything that can be tradable. It's a financial security according to Investopedia, right? So it can be anything like shares, bonds, debentures, mutual fund units, right? So CDSL stores all of that in the digital format. On the other hand, bank stores your money in the physical format. That's the basic of what CDSL does. CDSL helps in the transaction of financial securities electronically, digitally, right? So ownership of, let's say, some share, I want to give that ownership or I want to sell that share. So obviously that ownership will go to some buyer. So that transaction of me relinquishing my ownership and some other buyer taking over that ownership is conducted by CDSL. That's the service that CDSL provides. Right. And obviously, it also acts as a broker. It acts as a depository participant. Right. So basically, it's a middleman between investors and the stock exchanges. Right. So I, as an investor, want to buy some stocks. Right. And obviously, we have the stock market, the stock exchanges, BSE, NSE, whatever it is in India. So CDSL acts as the middleman to help facilitate the transaction between the investors and the stock exchanges. Right. And obviously for companies, it helps companies distribute their shares to investor and also maintain records. So if we take a look at CESR, right, on screener, and we have a lot of things to cover here. So in screener, there are ratios, quick ratios that are called. So this gives a very quick overview of the company based on some key indicators, key performance indicators, you could call it KPIs. Maybe not the best term, but for a free flow video, I believe KPI is a very good term to be used because what is a KPI? KPI is key performance indicators. It's mostly used in marketing to see whether marketing and even in that in advertisements. So when you have some Facebook ads, then we have a lot of KPIs to determine whether that ad is working to the level it should or not, right? So it can be used in this sense as well, where quick ratios are your KPIs, your quick key performance indicators, which helps you get a very fast overview of how the company is doing. So for in my case or in the case that I follow, we have certain ratios or certain, you could say, requirements which have to be mostly fulfilled, mostly for us to look deeper into that company because we don't want to trade, we want to invest. We are looking for a stock that we can hold for years to come and give good returns, right? So a portfolio that we are trying to build consists of stock which are very finely picked based on these KPIs. based on these quick ratios. And the parameters that we mostly follow or want this stock to mostly uh, tick are, first of all, market cap, which should be more than 7,000 crore. Again, this is the Indian stock market. The market cap should be more than 7,000 crore. This puts the company in the small cap region, but why small cap and not mid cap or large cap? What is the cap? Every market is divided into three segments. These are market segments: your small cap, mid cap, and large cap. So, based on the market capitalization of that company, its category is decided. Then we have ROC. What is ROC? Return on capital employed. Every company has a set of capital that it can use, right? Which basically it is capital at hand. So, if we put X amounts of capital, what return am I getting? That is what ROC is, right? But obviously, it comes in percentage form. So, if I put 100 and the return on capital employed is 17, then for every 100 employed, I get 17 back. That's the basic point. If I put 100 units of capital, then I get 17 units back. That is my return. It's obviously the higher the number, the better. But for this case, for this criteria that we have thoughtfully come up with, the criteria is to have a return on capital employed (ROC) to be greater than 17%, ideally greater than 20%. Right. Similarly, ROE. What is ROE? ROE is return on equity. So it basically is how well the company generates returns for their shareholders, for the equity holders, right? So if I have equity in a company, then based on its activities, what is my return for my equity? I have, let's say, 2% equity. So for my 2%, what is my return? What is my part of it? That is basically what return on equity is, right? So it basically measures profitability relative to shareholders' equity. Okay. It is calculated by net income upon shareholders' equity times 100. Whatever income I have, my total sales divided by shareholders' equity times 100. So if I have 2%, then I'll get 2% of that. Right. Next is CAGR, compound annual growth rate. This is mostly done for industries as far as I've seen. So this particular industry is growing at the rate of, when somebody says in that, then that it is referring to CAGR, compounded annual growth rate. What does it mean? What is the rate of growth of that particular, in this case, company annually? So every year, how much is it growing? Now we have some things which comes in the valuation point, which first of all, it is the book value. We see the book value. Book value is the net asset value of a company, right? So how many asset does the company have, which is total assets minus total liabilities. That's what book value is. So if we think theoretically, if a company liquidates all its assets, basically it sells all of its assets for cash, then that liquid cash will represent the book value of that company, right? Then we have face value. Next parameter is face value. Face value is when the stock was first listed on a stock exchange. Whatever value it was listed on, that was the face value of the stock, right? That is what a face value is. So it is the listing price of a company, of a stock. Then you have P by E ratio, which is price to earnings ratio. So it is basically how much investors are willing to pay per rupee of earnings. Right? So if I'm paying some price, what are my earnings? So I'm paying 100, what am I getting back? That is what price to earning ratio is. Then we have P by B ratio. P by B ratio is price to book value ratio. Right? So basically market price upon book value, that is what it is. Per share, but technically it is the same. Even if we have total or per share, the division will be the same. So it is market price per share upon book value per share. And we want a stock which has P by B less than 1, so that What does P by P less than 1 mean? That the price is less than the book value, right? That means the stock is basically undervalued. That it assets. What is book value? As I said, book value is is the liquidity obtained of if a company sold all of its assets, right? And price is basically the current market price per share. So if the ratio is less than 1, that means book value is larger than the price at current market price. That means the company is undervalued, which gives potential for growth, potential for that stock to show increases in its stock price. Right. That's why we want a P by V ratio less than 1. Now we have some financial indicators. First is sales. What is sales? Every company has some goods or services that it provides. Right. Some companies provide some products, some manufactured goods. Others provide services. Like, as I said, in the case of CDSL, CDSL provides services, right? So when these companies sell these goods and services, whatever money they accumulate is their total sale. We are not talking about how much profit they are generating. We are not talking about how much they have to pay, nothing. Whatever they are earning by selling, by that sale, the total of that is called sales, right? So it's the exchange of money for goods and services. That is what sales is. Now, obviously, it is very simple. For a key performance indicator, we would want the sales to be increasing. It's very simple. Then beyond expense. Again, expense is all of the things that the company has to spend money on in order to facilitate its operations, you could say, right? So the expense should be decreasing, obviously, because if expense is decreasing, then the profit will increase. We want that. Next thing is for the net profits to be increasing. Very basic, very obvious. Now let's come to balance sheet, right? Let's come to balance sheet. If we come into balance sheet of screener, right, we have lot of terms. We have equity capital, reserves, borrowings, other liabilities, total liabilities, fixed assets, CWIP, investments, other assets, and total assets. These are the indicators or factors that are displayed by Screener when it comes to balance sheet. So let's go through them one by one. What are reserves? Reserves are so obviously when a company accumulates profits, a part of their profits are spent on the growth of the company in any way, method that the company seems viable, right? Some companies invest more in that company. Some might buy some, I don't know, some property, some asset, whatever it is. After all of that, whatever profits that are accumulated by that company are called reserves. It's in the name. What is a reserve? Reserve is something that you have saved for later, right? So, reserves of a company are the accumulated profits that the company has retained, right? So, obviously, if the reserves are high, then the company is doing well. That is one first indicator, right? Or reserves are increasing, I should say. Next is borrowings. Borrowings, as the name suggests, is something that the company owes. It has to pay back at some point according to whatever contract or agreement they have come up with the lender, right? So borrowings should be decreasing, obviously. But there are some things which I will be covering later, but I just put a quick thing, you could say, light on it, is that borrowings of some companies or some companies based on their sectors will naturally be high because some companies you need a lot of money to grow, and all of that money cannot come from just the basic sale of their goods and services. So they have to borrow in order to grow, and then eventually they'll pay back their debt. So some companies naturally have a lot of borrowings, but we have to also check the sector of that company and find reasons whether that borrowing makes sense or not. Sometimes they have gained some big project, and for that they have to borrow a lot of money, be it for manpower, be it for equipment, be it for land, be it for any other asset, right? So we can't just go blindly on borrowings. We have to also take a look on what the sector or why the borrowings are as high and whether it makes sense in the long run or not. Right. So borrowings ideally should be decreasing, but as I said, right. Then we have cash flow. What is cash flow? Again, if we think fundamental, right? Have you ever opened a dictionary or just searched some word on Google and then Google dissects that word, right? It dissects that word into mostly some Latin terms. And then each term has its own meaning. So we have, let's say we have a word. Word is dissected by Google into two Latin terms. Latin term 1 and Latin term 2. Latin term 1 has its own meaning and Latin term 2 has its own meaning. When we combine these two, we have a combined meaning, right? Can you understand that when we combine term 1 and term 2, when we get the combined meaning of the original word, right? So that is how I am trying to explain this. So cash flow is made from two words, cash and flow. What is cash? What is flow? Flow is, well, in simple terms, it is something that is moving, kind of, right? So what does cash flow mean? Cash that is moving. That is what cash flow is. Now, the indicators that we're looking for is net cash flow to be positive. Well, why? Obviously, because if net cash flow is positive, that means the cash is flowing into the company, right? As I said, borrowings and reserves. If the borrowings are too much, then we have to pay back those borrowings, right? Debt, loan, whatever it is, we have to pay that back. If that is so large that whatever we are retaining is not enough and then we have to pay even more of that, that means the cash is going out of the company. Net cash flow is negative. Cash is not retaining in the company, it is flowing out. That is what we do not want. We want cash to come towards the company, right? So we want net cash flow to be positive. Now net cash flow is divided into three parts, even on Screener. If you open Screener again, then cash flow divided into three parts. Cash from operating activity, cash from investing activity, and cash from financing activity. What does this mean? Yep. Cash from operating activity or operating cash flow is basically the cash flow due to the operations of of that company or of that business, right? So it is the core business that is generating cash. The core operations of a company, the day-to-day activities that a company undergoes comes under operating cash flow, right? That has to be positive because again, that means that we have positive flow of money towards the company due to its activities, which is what we want. Then we have investing cash flow. Investing cash flow, we want it to be negative. But what is investing cash flow? Investing cash flow is the investment in long-term assets. So obviously when they're investing in something, we'll be putting down some money. We'll be putting down some stake. Obviously something is going outside of the company. And it has to be negative because that means that the company is investing in something, right? So we want the company to invest in something long term so that it gets returns in the long term. That is why we want investment cash flow to be negative. That again means that company is investing in something, the money is flowing outward, the cash is flowing outwards. Then we have financing cash flow. Financing basically means repayment of debt, distribution of dividend. Again, I have to come on what is dividend as well, right? So financing cash flow has to be negative, that the company is staying its debts. Negative financing cash flow, what does it mean? That the cash is flowing outwards and financing means it's going towards debts, it's going towards dividend. That means the company is paying off its debts and paying us dividends. We want that, right? So these are the points of cash flow. Again, summarizing it, net cash flow should be positive, operating cash flow should be positive, and investing and financing cash flow should be negative. Then we come to shareholding pattern. Shareholding pattern, again, if you open Screener, in shareholding pattern, we have promoters that are the core or the key persons of a company that hold a lot of equity. Promoters may not always be the ones who have started the company, but they might have joined later and hold a considerable amount of equity and are basically in the administrative unit, the executive unit of the particular company. Right. So we have promoters, we have FIIs. FIIs is foreign institutional investors. And then we have DIs, which is domestic institutional investors. We have government and then we have the public. Government, if some governments, it can be state government, it can be central government, they hold certain stake in certain companies, especially defense companies. So for example, HAL, which is Hindustan Aeronautics Limited, I believe the Karnataka government holds 50% plus stake in that company. So it is basically a government owned entity right now. And we have public, obviously public being that the company is listed on the stock market means it is publicly traded. That means the public can have share in that company. Now, key thing to kind of note here is that certain members of the public are high net worth individuals. They have a lot of net worth and they can buy a considerably large amount of the company as well to the level of promotery, right? So they should not be mistaken for promoters at all, right? They come in the public, but they are highlighted separately because of the amount or the level of their stake, you could say, correct? That is what shareholding pattern is. So that was the KPIs of the KPIs we have come up with to find companies that are worth investing in and are worth holding for decades and get 10x or higher returns. So that was the first part of this video. Again, this is free flow, so I don't know how large this video will come out as and how many parts it will come out as, because again, I have to cover my own part as well. This is not even my own part. This is the part that I should know, prerequisite. This was basically a revision of what I always obviously should know. Now we are going to be going deeper into screener. I'm going to be making a list of companies, and the list of companies will come from a query that again we have come up with. That query gives certain companies that mostly come under this criteria that we have set, and then after that I have to analyze all of these companies so that I can find anomalies and obviously present it in the workshop as well. Obviously I have to explain this as well, but after explaining this we'll be diving deep into certain stocks as well. So that was it for the part 1 of this video. I am actually quite impressed that even though this was pre-flow and even though I have basically 2 hours more to prepare, I was like, let's just make some content around it. Let's just be authentic. Let's just give a unique day in my life of me being almost 20. I am 2 months away from 20 now and holding my first finance workshop. I've held a workshop before, which was a video editing workshop, but this is the real deal kind of, because a lot of people will be showing up and there will be a lot of pressure as well to perform. So yeah, I also have to look back into the union budget, the election day, the US tariffs, the new tax slab, the 8th pay commission, all of that I have to revise as well, because they again hold significant importance in whatever is unfolding in the market. If you know, the Indian stock market has been in the last couple of weeks. So we have to also, or I should say, I have to also look deep into the reasons behind that. So yeah, this was the part 1. Maybe this is the only part. So yeah, that was it for today. My name is Prajal Pawar. I'm trying to bring my personal brand. I'm trying to be authentic with you, as I said in my previous video, of how I am building my personal brand and how you could too. This is one of the biggest opportunities in 2025. You should not miss it because I am not missing it. That was it. See you in the next one.